Imagine waking up, checking your bank account, and realizing the number there doesn't actually represent value. It represents trust. Trust in a system. Trust in institutions. Trust that everyone else will continue believing what you believe. Money feels solid, but the system behind it? It's surprisingly fragile. Today, we're breaking down how money actually works. From taxes and banks to inflation, credit scores, investing, and time itself. No jargon, no boring lectures, just the system explained clearly. Let's start where most people feel it first. 1. Taxes. The first cut. You work all month. You earn $2,000, but you don't receive $2,000. Before the money touches your hands, a portion disappears. Income tax, state tax, retirement contributions, healthcare funding. It can feel unfair. But taxes are how governments function. They fund infrastructure, public services, defense, education, and healthcare systems. There are different types. Income tax, taken from what you earn. Sales tax, taken from what you spend. Capital gains tax, taken from investment profits. Then there are payroll taxes, money collected for future retirement benefits and medical coverage. Whether you like it or not, taxes are the entry fee to modern society. 2. Banks, where your money actually goes. Most people think banks store money. They don't. When you deposit $1,000, the bank does not lock it in a vault. It lends most of it to someone else. This system is called fractional reserve banking. Banks keep only a fraction of deposits available at any time. The rest is loaned out for mortgages, businesses, cars, and credit cards. Why? Because not everyone withdraws all their money at once. Banks earn profit from the difference between the interest they pay you, the interest they charge borrowers. Your savings account might earn 1 to 3%. A borrower might pay 6 to 20%. That gap is the business model. Banks are not storage units. They are money circulators. 3. Interest, the silent multiplier. Interest is the cost of borrowing money, or the reward for lending it. There are two main types. Simple interest grows at a fixed rate. Compound interest grows on both the original amount and the accumulated interest. Compound interest is powerful. If you owe money, it works against you. If you invest money, it works for you. Small amounts grow slowly at first, then faster still. Over decades, compound growth becomes exponential. This is why time matters more than timing. 4. Inflation. The invisible leak. Inflation is the gradual decline in purchasing power. Your money might look the same, but it buys less over time. Why does inflation happen? Sometimes demand increases faster than supply. Sometimes production costs rise. Sometimes too much money circulates in the economy. A small amount of inflation is normal. But when it rises too quickly, savings lose value. Wages struggle to keep up. Living costs increase. To control inflation, central banks often raise interest rates. Higher rates mean borrowing becomes more expensive. Spending slows down. The economy cools. It's a balancing act. 5. Recessions, economic reset. A recession happens when economic activity declines for an extended period. Businesses earn less. Consumers spend less. Unemployment rises. Recessions are painful, but they are part of economic cycles. Boom, peak, slowdown, recovery. Governments may lower interest rates, increase spending, or introduce stimulus programs to encourage recovery. Eventually, growth resumes, but rarely without scars. 6. Credit scores. The trust score. A credit score is a number that measures reliability. Not wealth, reliability. Lenders use it to decide, will this person repay borrowed money? Your score is influenced by payment history, how much credit you use, length of credit history, types of credit, new credit applications. A strong credit score lowers borrowing costs. A weak one increases them. It's not about being rich. It's about demonstrating consistency. 7. Currency, the shared illusion. Money itself has no inherent power. It only works because we agree it does. Paper currency, digital balances, even cryptocurrencies. They function because society collectively trusts them. Governments issue currency. Central banks regulate supply. People exchange it for goods and services. If too much money is created, inflation rises. If too little circulates, economic growth slows. Money is not valuable because it exists. It is valuable because people believe in it. 8. Investing, making money work. If inflation slowly reduces purchasing power, investing is the defense. Investing means allocating money into assets that may grow over time. Common examples: stocks, ownership in companies; bonds, loans to governments or corporations; funds, diversified collections of assets. Real estate investing carries risk. Markets fluctuate, values rise and fall. But historically, long-term investing has outpaced inflation. The key factors: diversification, patience. Time wealth usually builds gradually, not dramatically. 9. Value, the real driver. Value determines income. Gold is just metal, but scarcity and demand give it price. A product becomes expensive when people perceive it as useful, rare, or desirable. The same applies to skills. The more valuable your contribution to others, the more compensation you can command. Income scales with impact. 10. Time, the ultimate asset. Time is the multiplier behind everything. Money invested over decades compounds. Skills practiced over years sharpen. Reputation built consistently strengthens. Wealth is rarely built in days. It's built in decades. 2 people can earn the same salary. The one who invests consistently and starts earlier often finishes with dramatically more, not because of luck, because of time. Closing message: money is not mysterious. It follows systems. Taxes move it. Banks multiply it. Inflation erodes it. Interest accelerates it. Investing grows it. Time transforms it. Most people work for money. Few people understand how money works. Once you understand the system, you stop reacting to it and start positioning yourself inside it. And that shift, that's where real financial power begins.